Today, the RBA pauses for now. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post. Today we look at the RBA decision and the implications ahead. And the RBA, of course, left the cash rate unchanged on Tuesday, but the narrative in their release highlighted the fact that there was potentially an opportunity for lifting rates later. This is more about seeing the impact of past decisions rather than the end of the tightening cycle. Though, of course, in the media, a lot of people were talking about the RBA pivoting. Now, I'm not sure that's the case. Anyway, in the release, they said, at its meeting today, the board decided to leave the cash rate target unchanged at 3.6% and the interest rate on exchange settlement balances unchanged at 3.5%. The decision follows cumulative increases in interest rates of 3.5 percentage points since May last year, of course, 10 in total. The board recognises that monetary policy operates with a lag and that the full effect of this substantial increase in interest rates is yet to be felt. The board took the decision to hold interest rates steady this month to provide additional time to assess the impact of the increase in interest rates to date and the economic outlook. They went on to say that global inflation remains very high. In headline terms, it's moderating, although service price inflation remains high in many economies. The outlook for the global economy remains subdued, with below average growth expected this year and next. The recent banking systems problems in the United States and Switzerland have resulted in volatility in financial markets and a reassessment of the outlook for global interest rates. These problems are also expected to lead to tighter financial conditions, which would be an additional headwind for the global economy. The Australian banking system is strong, they said, well capitalised, and highly liquid. It's well placed to provide the credit that the economy needs. A range of information, including the monthly CPI indicator, suggests that inflation has peaked in Australia. Goods price inflation is expected to moderate over the months ahead due to global developments and softer demand in Australia. Meantime, rents are increasing at the fastest rate in some years, with vacancy rates low in many parts of the country. The prices of utilities are also rising quickly. The central forecast is for inflation to decline this year and next to around 3% by mid-2025. Medium-term inflation expectations, they say, remain well anchored, and it is important that this remains the case. Growth in the Australian economy has slowed, with growth over the next couple of years expected to be below trend. There is further evidence that the combination of higher interest rates, costs of living pressures, and the decline in housing prices is leading to a substantial slowing in household spending. While some households have substantial savings buffers, others are experiencing a painful squeeze on their finances. The labour market remains very tight. The unemployment rate is at a near 50-year low, and underemployment is also low. Many firms continue to experience difficulty hiring workers, although some report an easing in labour shortages, and the number of vacancies has declined a little. As economic growth slows, unemployment is expected to increase. Wages growth is continuing to increase in response to the tight labour market and higher inflation. At the aggregate level, wages growth is still consistent with the inflation target, provided that in productivity growth picks up. The board remains alert to the risk of a price-wages spiral, given the limited capacity in the economy and the historically low rate of unemployment. Accordingly, it will continue to pay close attention to both the evolution of labour costs and the price-setting behaviour of firms. The board's priority is to return inflation to target, and high inflation makes life difficult for people and damages the functioning of the economy. And if high inflation were to be entrenched in people's expectations, it would be very costly to reduce later, involving even higher interest rates and a larger rise in unemployment. The board is seeking to return inflation to the 2 to 3% target range while keeping the economy on an even keel, but the path to achieving a soft landing remains a narrow one. The board expects that some further tightening of monetary policy may well be needed to ensure that inflation returns to target. The decision to hold interest rates steady this month provides the board with more time to assess the state of the economy and the outlook in an environment of considerable uncertainty. Assessing when and how much further interest rates need to increase, the board will be paying close attention to developments in the global economy, trends in housing spending, and the outlook for inflation in the labour market. And the board remains resolute in its determination to return inflation to target and will do what is necessary to achieve that. And of course, the cumulative effect of all the rate rises so far are significant. Recent data showed that following the recent lift in rates for a typical $500,000 loan with 25 years remaining on principal interest, the total increases from May last year to April this year is the equivalent of $983 a month. A loan of $750,000, though, is equivalent to an increase of $1,474 a month, and $1 million loan, which of course for many people is not that unusual, is nearly $2,000 extra every month. So this is going to have a significant damping impact on the broader economy. Now, there's a few points to make here which I think are worth thinking about. Firstly, of course, there is this global uncertainty with regard to the banking system and Credit Suisse and the other recent indicators. Clearly, the banking system is under pressure and we expect that to continue. More importantly, locally in Australia, the situation is that there is definite tightening around. We saw that in the credit numbers we discussed the other day. And it is likely, therefore, that home prices will not recover, as I discussed recently. So we should take this more as an indication that the RBA is indeed waiting for more information. The next inflation, the quarterly inflation number, will be important. And of course, the other factor there will be the fixed rate move. There are around 880,000 loans that are due to be repriced from fixed rates, which are very low, to much higher rates ahead this year. And that's going to have a further dampening effect. So, bearing in mind it takes 12 to 18 months to see the impacts of monetary policy change, it makes some sense for the RBA to pause, as I said they would this month. But of course, it doesn't mean that the end of the cycle is here. The chances are we will see higher interest rates ahead, and therefore those who are spruiking this as the turning point are, I think, misleading us all. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.